Listen, this protects money, not feelings. If you walk into 2026 with a large idle cash position because you want to be safe, you're not being safe. You're choosing a slow, predictable loss of purchasing power and a guaranteed underperformance versus disciplined capital. I've seen this exact behavior in every late cycle environment. People hoard cash at the wrong time, then they deploy it emotionally at the worst time. I'm going to give you a cleaner approach, not a headline-driven approach, a structural approach, one that treats cash as a tool, not a destination, and one that assumes 2026 will not reward laziness. It will reward discipline, cash flow, and intelligent liquidity management. That's what we're doing today. You don't need more opinions. You need a rule set that makes it difficult to lose money in the obvious ways. Most investors misunderstand cash because they treat it as risk-free. Cash is not risk-free. Cash is price stable in nominal terms, but it is not value stable in real terms. Holding cash is a choice to accept whatever inflation does to you and to accept whatever opportunity cost the market charges you while you wait. In a zero-rate world, cash was a dead asset. In a positive-rate world, cash can be a productive tool if you actually put it to work properly. And that distinction is the entire point. Because don't hold cash does not mean don't hold liquidity. It means don't hold idle, non-yielding, unstructured cash and call it a strategy. If you do that in 2026, you're going to watch your portfolio shrink relative to assets that pay. Not because the market is cruel, because the math is consistent. Now, I want to reframe this topic the way professionals see it. Most people think the decision is binary, cash or risk assets. That is amateur framing. The real decision is, how do I keep liquidity while getting paid? How do I stay liquid enough to act without leaving return on the table out of fear? How do I protect my downside without surrendering my upside? The public conversation around cash is emotional. It's always emotional. People say cash is trash when markets are euphoric. Then the same people say cash is king after they've already taken the drawdown. Both statements are incomplete. Cash is not trash. Cash is not king. Cash is a wrench. It's a tool you use in a system. If you don't have the system, the tool doesn't help you. It just sits there. And if you hold too much of it at the wrong time, it quietly destroys your compounding. I'm not guessing here. I've watched multiple cycles where the crowd did the same thing. They waited for clarity. They waited for the bottom. They waited for rates to come down. They waited until the risk premium had already collapsed and the opportunity had already passed. And then they deployed cash, right when everyone else did, because they finally felt safe. That is not disciplined investing. That is delayed emotional decision-making. I don't try to feel safe. I try to be solvent, liquid, and paid. That's the difference. So here is my core framework for 2026. These are the rules. Rule 1. Liquidity is non-negotiable. Idle cash is optional. Liquidity means you can act when the market offers you price. Idle cash means you are paying a real return penalty because you don't have a plan. Rule 2. Every liquid dollar must have a yield, a purpose, and a redeployment trigger. If it doesn't, it's not strategic. It's just sitting. Rule 3. In 2026, the cost of capital is still a central variable. Even if policy rates move, long-term rates and credit conditions will be driven by inflation expectations, fiscal supply, and risk premiums. You do not build a portfolio around the assumption that financing becomes easy again on schedule. Rule 4. Safe assets can be unsafe at the wrong price or duration. Duration risk, exposure to long-term rate moves, is where many conservative portfolios get quietly damaged. Rule 5. The job of a portfolio is not to win arguments. The job is to survive the full cycle and be positioned to buy when others are forced to sell. Now I'm going to take you through what I would do instead of holding cash in 2026. Step by step. No hype, just mechanics. First, I separate cash into 3 categories. Category 1, operational cash. This is money you need for bills, payroll, taxes, near-term obligations. This money is not an investment decision. It's a liquidity requirement. But even operational cash can be optimized. Insured cash accounts, short-duration instruments, and structures that preserve access while still earning something. Category 2, strategic liquidity. This is money you want ready because you anticipate opportunity. This is where most people fail, because they hold it in the laziest possible form, idle deposits, when they could hold it in instruments that pay, preserve liquidity, and reduce regret. Category 3, Long-term capital. This is money that should not be sitting in cash. If your time horizon is measured in years and your cash is measured in just in case, you're committing a structural error. Long-term capital needs exposure to productive assets and inflation-resilient cash flows. You can be conservative without being idle. Now let's talk about the most important point. What replaces idle cash in 2026 is not going all in. It's building a yield ladder, a cash flow core, and a measured risk sleeve. It's a barbell, executed with discipline. Here is the actual do this instead plan. 1. Turn idle cash into a T-bill ladder. If you want liquidity, you do not need to accept zero return. You ladder short-duration U.S. Treasuries, 4-week, 8-week, 13-week, 26-week. So maturities are constantly rolling and you always have fresh liquidity. This accomplishes 3 things. It pays you. It reduces reinvestment risk because you're constantly rolling at prevailing rates. And it preserves your ability to act without selling risk assets at a bad time. This is how professionals hold cash, not as dead deposits, as rolling short-duration instruments. 2. Keep duration short unless you are explicitly making a duration bet. A lot of investors who think they're being conservative load up on long-duration bonds because they want safety. Then long rates rise, prices fall, and they discover they owned a leveraged duration position. If you want stability, you keep duration short. If you want to bet on falling long rates, then admit it's a bet and size it like a bet. Most people don't. They drift into duration risk because it's labeled bond fund, and they assume bonds can't hurt them. They can. 3. Build a cash flow equity core that can self-fund in higher cost environments. In 2026, I want businesses that can finance themselves, strong free cash flow, manageable debt, pricing power, a history of shareholder returns, not the highest yield, the highest quality. Because in a world where refinancing costs matter, weak balance sheets become equity problems, not just bond problems. And if you're holding companies that depend on cheap credit, you're holding a portfolio that's structurally fragile. You might get paid for it in a liquidity boom, but you will get punished for it in a tightening regime. 4. Add selective credit exposure when you are being paid for it. This is where the public gets confused because they treat bonds as one category. They aren't. Credit is a spectrum of risk, and in 2026, the maturity wall and refinancing cycle will continue to pressure weaker borrowers. S&P Global Ratings has noted that about $1.35 trillion of non-financial corporate debt is set to mature in 2026, as of October 1, 2025, which is exactly the type of rolling pressure that changes corporate behavior and investor outcomes. S&P Global Ratings. When that amount of debt has to be refinanced, it affects spreads, issuance, equity buybacks, dividends, and profitability. So I want credit exposure that is high quality, laddered, and intentional, not a blind reach for yield. 5. Own inflation and policy hedges, small, deliberate, and for specific jobs. Gold is not a growth asset. It's insurance against policy and fiscal slippage. It is there because governments have incentives that do not align with your purchasing power. A small allocation can reduce the probability that one macro regime wrecks your portfolio. Bitcoin, if you own it, is not digital gold in the way people market it. It's optionality, high volatility, reflexive, sensitive to liquidity and sentiment. If you treat it like a religion, it will punish you. If you treat it like an option, it can serve a purpose. But you size it so it can't hurt you. And you do not confuse it with a cash substitute. Now let's get into the deeper analysis. Why holding cash in 2026 is so seductive and why it's often wrong. The reason people hoard cash late cycle is psychological. Cash makes you feel in control. Cash feels like certainty. But in markets, certainty is expensive. You pay for certainty in the form of opportunity cost and inflation drift. And then, when volatility hits, you make a second mistake. You refuse to deploy because you want a better price. So cash becomes a permanent non-decision. And a permanent non-decision is still a decision, one that compounds against you. Here's what actually happens in most cycles. When markets sell off, the first move is fast. Then you get a series of volatile rebounds. Then you get despair. Most cash holders do not deploy on the first move because it feels too early. They do not deploy on the rebound because they feel they missed it. They do not deploy in despair because they feel it could get worse. So they deploy when the market stabilizes, after the discount is gone. This is why the "I'm waiting in cash" crowd consistently underperforms. Not because the idea is irrational, because their process is undefined. If you want to hold liquidity, you need pre-committed triggers, valuation thresholds, spread thresholds, rebalancing bands, rules that don't negotiate with your emotions. That's how you convert liquidity into a weapon. Otherwise, it's just fear sitting in an account. Now let's talk about 2026 specifically, because don't hold cash depends on what regime you're in. In 2026, the world is still dealing with the aftermath of a major repricing of money. Whether you call it higher for longer or something else, the key is that the marginal borrower is under pressure. Households feel it through mortgage costs, and mortgage pricing in the US is tied more closely to longer-term rates than to short-term policy rates. Fannie Mae has explained that mortgage rates are determined by adding a spread to the benchmark 10-year Treasury note Fannie Mae. Bankrate has also noted that typically the gap between the 10-year Treasury yield and the 30-year fixed mortgage rate spans about 1.5 to 2 percentage points, though that spread can widen when risk rises. Why does this matter in a script about cash? Because it tells you something structural. Even if short-term rates move, long-term financing costs can stay elevated if inflation expectations, term premium, or risk spreads remain sticky. That affects housing demand, consumer behavior, and corporate investment. It affects everything. So 2026 is not a year where I assume the old low-rate environment returns and makes every asset levitate. It may ease, but easing does not guarantee a return to free money. And this is exactly why you don't park capital in idle cash and wait for the world to become simple. The world will not become simple. You build a portfolio that survives complexity. Now, I want to address the most common mistake I see in the "don't hold cash" conversation. People hear "don't hold cash" and they do the dumb version of it. They go from 40% cash to 5% cash overnight. They buy whatever is moving. They buy illiquid private deals. They buy long-duration growth at high multiples. They buy speculative assets because they associate cash with missing out. That is not what I'm recommending. I'm recommending a conversion from idle cash into structured liquidity and productive cash flow. You are not removing liquidity. You are removing laziness. Here is how I would structure it mechanically, without telling you to buy specific tickers. I would build a liquidity ladder, short-duration treasuries, with maturities every month. I would hold a core of high-quality cash flow equities, dividend growers, not yield traps. I would allocate a sleeve to high-quality credit with defined maturity exposure. I would maintain smaller hedges, gold, and optionality if you choose it. And I would keep a disciplined rebalancing rule. When risk assets fall and yield spreads rise, I redeploy maturing T-bills and rebalance systematically. That is what "do this instead" means. It's not a prediction, it's a machine. Now I'll speak directly to you because some of you are going to resist this. If you are holding a large cash position because you are waiting for certainty, understand what you are waiting for. You are waiting for the market to tell you it's safe. The market only tells you it's safe after prices have already adjusted upward. That's how markets work. Safety is expensive. Opportunity is uncomfortable. If you want to preserve capital and still grow it, you need to accept that the best entry points rarely feel good. They feel rational, not comfortable. That is why rules matter. Now, the counter-arguments. Cash is paying a lot right now. Why not just hold it? If your cash is in short-duration treasuries or structured cash equivalents earning meaningful yield, that is not the same as idle cash. That is a strategic liquidity position. But if you're holding non-yielding cash or you're sitting in cash because you have no plan, you're still losing in real terms and you're still paying an opportunity cost. Also, remember, when the turn comes, yields may fall. And if you've built no risk exposure and no cash flow base, you'll face a second problem: reinvestment at lower yields while risk assets reprice higher. Isn't it safer to wait until 2026 is clearer? No, not if you define clearer the way most people do. Clarity arrives when the market has already moved. The correct approach is partial, structured exposure, built around durability, so you benefit regardless of whether the next move is sideways, down, or up. What if there's a recession? Shouldn't I be in cash? If you're worried about recession, the answer isn't idle cash. The answer is liquidity plus quality. Short-duration treasuries, high-quality cash flow businesses, and the ability to rebalance when spreads widen. Recessions punish fragile balance sheets and reward solvency. If you own solvency and you have liquidity, You don't need to predict the exact month of a downturn. You just need to survive it. Now, the forward-looking insight, stated calmly. In 2026, the portfolios that shrink will be the portfolios that did one of two things. They stayed idle in cash for too long and then re-entered risk too late. Or they fled cash in a panic and bought the wrong risk. Illiquid, long duration, overvalued, and dependent on easy refinancing. The portfolios that hold up will be the ones that treated liquidity as a yield-bearing tool, built a cash flow core, and kept enough optionality to buy when others are forced. That's it. No mystery, just structure. So here is the simple statement to carry forward. Don't hold cash in 2026. Hold liquidity that pays you. Hold assets that self-fund. Hold optionality that cannot destroy you. And run the whole thing by rules, not by mood. Now, if you want continued clarity like this, without noise, without emotional forecasting, subscribe. Not because you need more content, because in 2026, discipline will matter more than opinions. And watch the next analysis, because I'm going to break down the most dangerous cash replacement mistakes people make: duration traps, yield traps, and illiquidity traps, and how to avoid them without sacrificing returns. That's how you save a portfolio, not by hiding, by structuring.